And because interest rates, local interest rates have been trending down or have trended down, then we would have seen our interest expense going down. I would expect this interest expense to go down a bit further once rates resume their downward path. I guess you could say that rates are a little bit on a pause now, but we expect over the medium term for this to continue, given the state of the Jamaican economy currently. So, from a total investment income point of view, there was an improvement in the negative figure. I mean, it was negative 23.19 million, and this compares very favorably with negative 125.65 million for the similar period last year. Net investment income also showed an improvement from which with an outturn of negative 150.2 million versus negative 226.96 million for the same period last year. And earnings per share would have also seen an improvement, moving from negative 0.53 Jamaican cent dollars to 0.72 Jamaican dollars for the similar period last year. And finally, which is a very important metric to watch, book value per share is now at 26.01 Jamaican dollars, up 8.7% versus $23.93 for the same period last year. And of course, just tracking the return metrics, as I said before, total value to paid in capital 1.79 times, and average return on equity 17.47% since inception to the end of the last financial year. Now, there's a few items on the income statement to highlight. I spoke about net interest income, and you can see the improvement. Net interest income 83.6 million negative versus negative 130.825 million. And I spoke about the improvement in interest expense and the improvement in interest income. Now, as we go through time and we deploy more investments into REITs, into higher yielding REITs, we expect to see an improvement in interest income. And our objective is actually to get the ratio of income generating assets such as REITs above 50% of the portfolio versus where we are now. Lease and other income would have improved relative to the same period last year due to recoveries that we have had from assets that are under workout. Next list item I want to highlight is fair value loss, which came in at 33.62 million versus 28.56 million for the similar period last year. And again, this is mainly driven by adjustments to the third-party REITs that are in receivership. From a balance sheet perspective, shareholders' equity is now 9.03 billion, and that's up 15.6% versus 7.81 billion for the similar period last year, while total assets improved to 17.18 billion, up 13% versus 15.2 billion for the similar period last year. And you can see again that 5.1 billion in paid in capital by shareholders, and we have converted that to 9.1 billion. As I said before, we generate a multiple of 1.79 times. From an efficiency and management expense ratio perspective, we have set ourselves 3.5% threshold to ensure that every dollar that we generate in revenue expenses doesn't amount to more than 3.5%. And you can see where, even though this ratio is up versus last year at 3% versus 2.7%, we have consistently been delivering according to our promise to keep management expense ratio within best practice globally. From an efficiency ratio perspective, we normally measure that at the end of each financial year, simply because during the interim quarters, as we have explained on numerous conference calls, the quarterly results being lumpy. We normally have a negative outcome, and therefore we can't really measure the efficiency ratio until year end. That ratio, though, is a 45% threshold level, and we have, consistently been delivering the year-end financial results at below that ratio. Very briefly on investment activity, real estate investment assets. We have 16.8 billion invested across 15 different real estate investment assets at the end of the quarter, and this was up 21.2% versus similar period in, last year. And this 16.77 billion is comprised of 10.7 billion in total property investments relative to 9.81 billion last year, 1.99 billion in REITs, up from 1.65 billion, and this is in keeping with trying to deploy more capital into income generating assets to increase net interest income. Joint ventures, 4.02 billion, up from 2.37 billion last year, and of course this would have been driven both by the One Belmont JV as well as a new JV that would have entered in a beachfront property in Trelawney during last financial year. And finally, it wasn't a really active quarter. We exited 43.89 million relative to 1.65 billion in exits that we had for the same period last year. Investment allocation, we are pretty well diversified by real estate category, and by investment category, investment property is still represent the bulk of our investment assets, now at 61.5%. Granted, this has been coming down gradually over time. At one time, we were close at 75%. We are now at 61.5%, and we intend to bring that figure down even more. As we said before earlier on the call, with breaking ground on the Lake Spend asset, pretty soon investment property will be heading low. So we'll just continue to seek to unlock value from all of these assets that we hold on the balance sheet. From a key strategic assets on the balance sheet, nothing has changed there relative to where we were at year end. However, I just highlighted the Lake Spend holdings, which is a 55.4 acre industrial property, which as I said before, David will provide a lot more information on this. And this is obviously an important and key milestone for SRF because it is the first major project that we are undertaking in the second investment life cycle of SRF. And speaking about major groundbreaking, I will now hand over to David to take us through the various assets that are held on the balance sheet.
Thanks, Jason, and good morning, everyone. The first one, as you can see on the screen, I'm going to elaborate on the Lake Spend, which, as Jason said, is our flagship industrial project and our first major investment of the second cycle. The groundbreaking on 9th of December, we had the Prime Minister as the keynote speaker. And as you would have seen from the extensive and very positive media coverage, social media coverage that the ceremony received, between the Prime Minister and Minister Hill, a lot of the rhetoric surrounded this project was used to demonstrate to the world that Jamaica remains open for investment, despite the damage that the country would have suffered under Hurricane Melissa. The next page you can see here, next slide, we have the website for the project, which of course persons can go in to get information on the status and also what other information, material, and data of interested persons would want to access would be here on the website. We go to the next slide, please. And let me go a little bit into the project itself for some more specific details. We believe that what we have brought to the market here is a unique proposition, because I'm sure you will all be aware there are several other industrial offerings that have come to the market pretty much at the same time. But we believe that there is sufficient demand in the industrial space, to warrant that these various industrial projects can all coexist. And besides, we are a firm believer that a rising tide lifts all ships. So we believe that there's room for success all around. Some of the key features that our park will deliver to the market is an underground electrical distribution system. And I believe we would have all seen and learned from Hurricane Melissa the level of destruction that a hurricane brings to a grid, electrical grid. But by having a distribution system in the park that is underground, you build in resilience and business continuity from day one, so that in the event of the passage of a major hurricane, from the day afterwards, you can get back up and running in your business because there is unlikely to be any disturbance to the electrical system. So the park is 55 acres, 55.4 to be exact, which will yield us about 34 service lots. And when I say service lots, this simply means what we're delivering is a secure park with all the infrastructure to purchasers, so roads, sidewalks, landscaping, sewage, water, underground electricity, security, graded lots, drainage, the works, so that each purchaser can buy a lot and design and build, whether it's their own cold storage, their own warehousing, their own distribution center. The clients get the flexibility to build to suit their particular business needs. The other unique features that we believe gives us an advantage in the marketplace here is the fact that we'll have a reserve water storage for the park, 70,000 gallons. And of course, we did extensive studies with a hydrologist to understand the water flows, the flood levels, and so on. So there are several retention ponds and so on that you'll see in our upcoming diagram that we'll be doing the grading and the drainage such that there's, significantly reduce the likelihood of anybody being interrupted due to flooding in the area. And of course, the other thing we are delivering here is a secure industrial park, meaning that we're the only ones who are doing a 8-foot concrete wall around the entire 55 acres, with a rapid response. So there will be a gated community, gated to go in and out. And that's something that, again, we believe we are unique in the marketplace in delivering a secure industrial park. We go to the next slide, please. So here is the layout. As you can see, it's on the top left is where the entrance is. That is off the Lakespen Road. As you can see there, it's triangle shaped with a central road in the middle, and the lots, as you can see, they're numbered from 1 to 34 on the screen. I already spoke about the wall. The lot sizes themselves range from 0.8 up to 3 acres. And of course, I think the key takeaways from the subdivision plan here, but it is a subdivision, of course, so each purchaser will get their own title. The key takeaway is the fact that we have designed in business continuity and resilience with the underground system. We've designed in proper drainage and retention ponds. You see those two blue squares at the bottom there, those are the retention ponds, so that the security, circulation, all of these things, we have been very, very careful and deliberate in delivering this. And I should add that the decision for SYGNUS Real Estate Finance to design the underground electrical system was done long before Hurricane Melissa. So this is not a knee-jerk reaction to the destruction of the electrical grid out west. this was always our intent to deliver to the marketplace a industrial park that had resilience and business continuity designed in from the start. We'll go to the next slide, please. And these are just a couple of snapshots from the groundbreaking ceremony. There you can see the Prime Minister. Just to give you know, this picture would have been in the media. Very quickly on the left, that is myself. That is this SYGNUS Ministry of Finance Chairman, Mr. Masado, the Prime Minister, Minister Hill, one of our co-founders and Chief Investment Officer, sorry, Chief Operating Officer, Dr. Johnson, and Mr. Ivan Wu from China Harbour, who are the contractors on the project. Next slide. Again, just another snapshot on the left-hand side. I'll just highlight, you know, in the red tie, that is Mr. Dwayne Price. He's the lead on the project here at SYGNUS, as well as the other members of the GDM team, as well as Mr. Ivan Wu from China Harbour. On the right-hand side is the significant moment where we turned the earth to essentially mark the ceremonial start of the project back on the 9th of December. Next slide, please. So I'll now move on to the Miami Bay project, which again, as you will have heard from previous briefs, is our flagship hospitality asset. And I can safely say that we are continuing to make very good progress towards the decision phase of this particular project. And of course, in due course, you know, once we are at that phase, you know, we'll come back to you to update you on exactly what the decision is. We go to the next slide, which is the Delphin Holdings. This is in Trelawney. Again, it is, as you can see, the second of our beachfront properties, a fantastic beach. And once again, we're making very good strides in reviewing the options for us to unlock the value here. And there are multiple options that we have. But clearly, as you understand, you know, the process we go through is meticulous. It involves liaison with the regulatory authorities as what they will allow. It involves a modeling. It involves speaking to designers, architects. So, but just to give a sense that we are looking at multiple options and on the optimal way to unlock the value of this particular property here. Next slide is the Belmont. Again, this is our flagship Grade A commercial office building, now 100% complete. And the penultimate tenant, so only one more tenant to the left after this one, is currently in the midst of their build out, as Jason indicated, and we expect them to move in and occupy their space by the middle of this year. Just a quick word so you understand when we say build out and so on, because and why these things take time. In that, when you do commercial buildings, particularly as a cold shell, each tenant, when they execute their lease, they then need time to do an interior design and layout. They have to get a contractor, and of course, once the contractor has built up the space to their specifications, then of course, you know, they have to do with the furnishing and equipment. So just give just a call in case someone asks a question: why does it take so long to occupy a building of this nature here? It's the same all around, because there is between practical completion and persons being in the building, there are several processes and steps of the interior design, procurement, contracting before persons can actually occupy the building. So that's it as far as the projects are concerned. I will now hand you back to Jason.
Thanks so much, David. So, final thing that I want to do is just give an update on our strategy and, you know, what we have been doing and what we'll continue to do. So, first key pillar is just execution of key strategic initiatives. David went at length already about the Expand Industrial Park. So, we are just bunkering down and executing on that for the remainder of this financial year and into next financial year. On Belmont, David also gave the update there. So we simply just going through the process of structuring SRS partial exit. David also gave an update on Miami Bay. So there again, I don't need to expand much on that. We're also at the same time, one of our mandates is to deepen access to flexible capital. So we are looking at a number of different early estate investment notes, which are third-party developments that are under consideration, and as well as some co-developments, both in well, I guess you could say in Jamaican market as well as overseas. Portfolio realignment. I spoke earlier about the fact that we are actively and continuously increasing our investment in REINs to REIN/income generating assets, so that we can bolster net investment income, so that we can get that to net interest income, so that we can get net investment income as close as possible to a positive run rate on a quarterly basis over time as possible. And of course, investment comes with risk, and sometimes when you invest, everything won't work out properly. And so we do have some assets that we are seeking to, that we invested in as third-party investment, real estate investment notes, that we are actively pursuing a recovery, and those recoveries are going well. So we continue that process to execute on those, to get back that capital, and then redeploy that capital into other profitable investments. Second pillar of the strategy is we have taken a huge, I won't call it bet, but we took a decision to strategically deploy all our assets, our investments in Jamaica. So over the past five years, all we have been doing are Jamaican investments, taking capital and pumping all that capital directly into the Jamaican soil. And we continue to do so. But ultimately, SRF is a Caribbean real estate investment company, and so we are at the stage where we are considering a number of high-value opportunities in other countries, and at the appropriate time, when we find the right transaction, we will of course take that plunge by doing our first overseas, our first non-Jamaican investment as the opportunity may arise. Dry powder, of course, this is part and parcel of being a real estate investment company, which is the harvest, the capital that you have deployed in previous transactions, and then you redeploy that and recycle the capital. So we continue to do that. That's a continuous process. Also have bank credit lines, as well as we also, on an individual basis, will raise capital for individual projects on a case-by-case basis. And so we are continuing to do this as we seek to unlock value from the different assets that we have on the balance sheet. And whenever we have anything to announce, of course, we'll announce them as appropriate. Final and most important thing, or one of the most important thing, is the second dividend that SRF needs to consider. Really push to try and have that dividend paid during the last quarter. However, it wasn't appropriate for us to do so, and so we are considering what's a more appropriate time to pay a dividend or do a distribution as we ramp up on our exits. I did speak about the fact that we have a number of exits that we are, well, a number of workouts that we expect to exit in this financial year, as well as the One Belmont partial exit that is being structured. So we have a number of exits that we have on the cards, and at the appropriate time in 2026, we'll seek to pay a meaningful second distribution. So that's ends the presentation for today. I think we can now move to the section of taking questions.
Thank you, Jason and David. All right, so we will move into the questions immediately. And the first one is in relation to the REIN portfolio. The report notes the weighted average fair value yield on REINs improved to 9.9%, while REINs measured at amortized cost has a yield of 14.6%. Can you explain what is driving the gap between the two metrics?
That's a good question. So fair value yield, pretty much, you know, that is measuring what the income is relative to fair value of the assets, and depending on what happens with the asset, that yield can fluctuate, right? But based on how those assets were structured, the yield on those were pretty low. So for example, you can structure an asset with a coupon of 10%, and then let's say, I don't know, X% of profit, right? And so the yield on that asset would be just a 10% coupon, and relative to what the carrying value of the asset is on the balance sheet. While for amortizing type assets, which doesn't have any fair value component, then that would kind of reflect where our sweet spot is, which is closer to 15% as an investment, which is just, you know, we take $100, invest that, and we expect a 15% coupon to be paid on that. So that's really, it's really down to how we structure the REITs. The ones that are carried at fair value means that there's a component that depends on maybe profitability of the underlying development, and that's an uncertain outcome. And so that those have a lower coupon or dividend to be paid, versus straight amortizing assets where there's no percentage of profit to be had. It's just like when it's just okay. I'm gonna invest in a fixed income note, and that note does have a straight coupon, and those are structured with a much higher coupon.
Thanks, Jason. All right, so the next question is also in relation to the REIN portfolio. How quickly can SRF increase exposure to higher yielding third-party income generating REINs? And oh, you can continue. I'll give the next part a little bit later. Go ahead.
Yes, so that's also a good question. So we are pushing very hard for this, of course. Bear in mind that every time we basically do an investment in a third-party REIN, because a real estate project, 9 times out of 10, the way how that REIN is going to be structured is going to be based on a drawdown schedule, which means that even if tomorrow morning we had a $3 billion REIN to invest in, the $3 billion will not be deployed in one go, and therefore it will take a period of time, maybe a year or more, for the full amount of money to be drawn down. So with that said, we are pushing very hard, and we have quite a number of opportunities, but normally the drawdown occurs over a 12-month period. So I would say it might take a year or so to really get the REIN portfolio, as in the carrying value on the balance sheet, to be substantial, unless of course on the odd occasion where we may have an opportunity where there's an operating entity that we invest, or that borrows from us, or that we invest using a note, and all the capital is provided at once. Let's say somebody's buying a building and we are funding them, but those opportunities are normally rare. What's likely to happen is a new construction is going up and the developer is short, and therefore we would fill that gap for them with an investment in a REIN, and that, you know, it's gonna always take up to a year or so to draw down. So I would say it's gonna take a little while, maybe 6 months, 6 to 12 months, to really see that ramp up on the balance sheet, even though we may have approvals and have new investments, but all of it isn't reflected at once.
Thanks, Jason. All right, so we'll move a little bit to the project side and then come back to some of the questions in relation to the actual balance sheet. All right, so the first one is in relation to Miami Bay. The company would have applied to NEPA already, but is yet to make a formal decision phase announcement. Has the passage of Hurricane Melissa impacted the plans for the development asset? This is Miami Bay. And when do you expect to complete the decision around this asset?
So good question. And let me speak first of all to the passage of Hurricane Melissa and its potential impact. Essentially, this investments of this nature, from real estate standpoint, take the long view. So a Cat 5 event like Hurricane Melissa, of course, is really something that we take on board to design in for a resilient investment, because a typical hotel agreement normally spans 15, 20, 25, 30 years. So hospitality investment is done with a long view. So the passage of a hurricane really gave us the opportunity to clearly see the destruction that Melissa created, and essentially ensure that we design in some of the challenges that we have witnessed at the other properties, of course, which we have taken a look at. So that's to answer the question with respect to the impact of Hurricane Melissa. The second part of the question you said had to do with the decision phase. Clearly it's a major asset, and we're making very good progress, as I've indicated, to get to the decision phase. So yes, we do have NEPA approval already, but at the same time, there is a matter of market timing. There's a matter of making sure that our investment decision is driven by what will deliver the best return for investors and shareholders. Has it taken a bit longer than it should? Yes, you could probably say so. But rest assured, when we do come back and outline what our decision is, you will see and understand why it is that we were deliberate in taking our time to ensure that we did this right.
Thank you, David. All right, so a follow-up on the REIN question. Following on the strategy in place to grow the size of the investment notes or REINs in the portfolio, what yield profile and what subsectors are being targeted for these new investments?
So, good question. So, I would say the yield profile, of course, depends on many things, right? Depends on the tenor, depends on what type of REIN it is, which sectors, is it residential, is it industrial? Most of the REINs that we have seen so far are primarily residential. So there are a number of different things. It depends on how much equity is in the project and but generally speaking, SRF objectives to generate a double-digit rate of return on any REIN investment. If the investment is structured with an upside component where we can get a percentage of the profit at the end, and obviously that additional gravy, so to speak. So it's generally going to be double digit. We're not investing in anything that's single digit, so we're not competing, for example, with banks, right? We are targeting a particular part of the capital stack that is solving a problem that, for example, the traditional financial institutions can't solve. That's typically the space where we play, kind of a medium risk-ish. So it's typically double digit. And in terms of subsectors, we play in all the subsectors. So it's not that we are targeting any specific subsector for REINs, but normally where we see the need is normally in residential space. But we are open for any transaction that is in industrial or commercial, as the case may be, although those we don't really see a lot of those.
Thanks much, Jason. All right, so the next question is in relation to the weighted average cost of debt. So the weighted average cost of debt would have declined to 8.6%, partly due to the variable rate tranche or the debt benefiting from lower market rates. How much further do we expect the debt to, or the cost of debt to benefit from these reducing interest rates?
Good question. So, I mean, it all depends on how far down interest rates go, right? And at the moment, I think the central bank is being a bit cautious due to the threat of inflation, primarily driven by what has happened to the western part of the island from Hurricane Melissa. But from my point of view, I suspect that once we have gotten past the initial knee-jerk reaction from jumping food prices and our shortages dealing with construction material, etc., then we may get to a phase where to stimulate demand, rates need to, well, from my perspective anyway, the normalized rate, interest rate for the economy to operate and generate sufficient growth is perhaps several 100 basis points lower than where they are now. I don't know when we'll get there. Obviously, depends on the inflation path, but depending on how far interest rates go, then that's what's gonna drive how much lower the weighted average cost of debt can go. But hopefully, you know, we can get a 100 basis points reduction over, let's say, next 12, 18 months, thereabouts. That's my hope, but I'm not sure.
Thank you, Jason. All right, so we have a question in relation to One Belmont and the partial exit. So Jason, you spoke about the planned partial exit for One Belmont at different periods. Could more information be provided on what the monetization process may look like and what timelines SRF or ODIR they're looking at to complete this exercise?
Well, in terms of timeline, the process, the conceptualization would have started last calendar year, and we are moving to execution phase for this calendar year. In terms of the structure, basically, it's to utilize a structure that allows regular investors as well as institutional investors such as pension funds and fund companies to have a share of wallet of the revenues that the building generates, right? So without saying much more than that, basically allow you to buy and own a stake in the building, which means that you are getting the cash flow that the building or your share of the building is generating. So it's, you know, I know that it seems like it's taking a while, but as you can see with SRF, so far, everything that we have delivered and our promises in terms of saying we are working through the process to structure a transaction properly. And when we do come with this transaction, then you can see the reason why it would have taken so long. And Lake Spen is a case in point. It took us a while to get here, but you can see that by getting here, we have come with one of the best industrial asset on the market in terms of how David would have explained the design for, you know, for example, to protect against hurricanes by putting electricity underground, etc., planning for flooding, etc., etc. So it's the same thing with One Belmont exit. We are devising a structure that will allow anybody basically to own a participation rights within the bill, within the structure, and therefore, unlike, let's say you have to go and buy a floor, or which requires a lot of capital, then it's basically being allowing persons to investors to be able to buy whatever percentage of one bellman and own that and get the cash flow from that. So lots of bells and whistles and hoops to jump through to get to the finish line, but we are patient in ensuring that we model everything correctly and come with a very good value proposition for the exit, for SRF to get some of its investment cash out, but also for investors to be able to participate in a good asset.
Thanks, Jason. All right, so the next question is in relation to Lake Spen. What is the cost for the Lake Spen Industrial Park investment? What is the makeup of financing, and when should it be? What is the target completion date?
So as we would have put in the public domain at the groundbreaking ceremony, it's approximately $20 million in terms of the investment and the total development cost. When it's coming to market, we are expecting to deliver lots to the purchasers in the summer of 2027. So roughly 17 or 18 months from now. China Harbour, the contractor, they're on the contract already, and mobilizing. So, and of course, just to add that the groundbreaking ceremony in December was ahead of schedule. So you know, we're fairly confident that we will be delivering these lots to purchasers in the summer of 2027.
Thanks, David. All right, next question is in relation to the consolidated cash. SRF's consolidated cash is relatively low. Does SRF anticipate new financing in short order to prepare for new projects?
Good observation. So the way we're looking at SRF is we have some major execution. So of course we are exiting a few REITs, and we're also exiting partial exiting one Belmont, and at the same time we are deploying capital into Lake Spen. So it's a mixture of utilizing cash from exit, as well as where appropriate we will raise capital on a project by project basis as we see fit for those individual projects. In terms of major capital raising, we don't really have any major capital raising plans at the moment. But like I said, if for example Miami Bay is fast tracked for whatever reason, we may choose to raise capital at the Miami Bay level, and that might be a private raise. And if we see the need, we may do a SRF general cap raise, or we may use, you know, credit lines or bank financing. And so we have a mixture of sources of capital to tap. But at the moment, if the question is about, are we, for example, coming to market to do a big capital raise, the answer is not at this present moment, due to the mixture of different types of capital that we may tap. I mean, we may do a small private placement if required, but nothing major at the current period in time. But of course, if that changes, you know, we always obviously have to update the market.
Thanks, Jason. All right, so there was no update on the landfall property under 5658 LMR Limited. Could you provide an update on this asset, as well as the plans for the Montrose Road property to 16 Montrose Road, which was formerly a joint venture?
Sure. We do have updates on both of those projects. We've actually made extremely good progress on landfall. Clearly, once we have consummated it, we'll be able to share with investors and shareholders exactly what the plans are. But rest assured, like all of our other assets, we have been putting focus on the landfall property. It is also on oceanfront. So it gives us a really good opportunity to create value there. And we expect that before long we'll be able to share with you exactly what it is that we plan to do at landfall. For the Montrose property, likewise, we have been innovative in the way in which we're unlocking the value of this particular property. We do have a plan that is being consolidated at the moment. And again, once we have it's been consummated and so on, then of course we'll make the disclosures at the appropriate time. But what I can say, rest assured, is that we do have plans in place to develop both landfall and also the Montrose Road property.
Thanks, David. All right, so we do have a few more questions. The next question is for Jason. Does the consideration to venture into the Caribbean the wider Caribbean represent a deliberate move to de-risk from Jamaica and a move to watch the current business cycle in the Jamaican market as rates remain high?
The short answer is no. Good question, by the way. Short answer is no. So, like I said before, right, and maybe I should reframe this picture. Remember that SRF in its prospectus, we said that it's a Caribbean real estate investment company, right? So the intention was always to do Caribbean investment. But as I've said a number of times, especially at AGMs, was that in 2019, when the law/rules around real estate in Jamaica changed, which is what triggered the sea change in real estate developments that we have seen from 2019 to now. When we looked at the price per acre for property in Jamaica and compare it with other Caribbean islands, like, I just returned from Cayman less than 48 hours ago, and what they are selling property for per square foot right, in Cayman versus what it's being sold for in Jamaica. Of course, Cayman is an investment grade country, right? But Jamaica is on its way to investment grade, in my opinion. So, there's a massive price disparity. If I go to Barbados, the same thing. If I go to Bahamas, the same thing. So the price per square foot or price per acre for prime property in those markets relative to Jamaican market is huge. Now, one could say historically that Jamaica had a huge crime problem, and that's the reason why, our property prices are depressed and so forth and so on. Or you could say our economy was growing very slowly, etc., etc. But I mean, over the last year, crime has tanked in Jamaica, right? It has plummeted in terms of murders per 100,000. And okay, so we still have a lot of work to do in terms of getting GDP growth. I think that Jamaica needs to grow at like 5% for like 10 years non-stop, which we can do. I mean, DAMREP has done it, and we have laid the foundation to do it by bringing our debt ratio down. And our GDP per capita, which used to be about 5,500 US, is now at, I think, like 7,700. So it's growing, but we're not there yet. But I fully expect that improvement to happen. Now, so to go directly to the question, so we took a strategic decision to lay all our eggs on the Jamaican basket first, simply because we felt that bang for the buck, Jamaica represented substantially more value in terms of deploying that initial capital. And of course, there was a little matter of COVID that came and just kind of put some kind of derailed the pathway for some real estate assets in Jamaica. But no, this is to go beyond Jamaican shores is because we needed to deploy capital in Jamaica, make some statement investments in Jamaica, which I guess you could say we have kind of done that somewhat, depending on what perspective you are looking at it from. And now we are seeing opportunities that we think meet the criteria that we want outside of Jamaica, and in keeping with the mandate to be a regional real estate investment company, we are considering those, and once we put them through our process and they fit, then we will execute. So that's what's driving it, and nothing to do with business cycle or Melissa, etc. If anything, I think depending on what you're looking at, Melissa could represent some opportunities, but it's nothing like that. It's just as we build out SRF and relationships expand and our own expertise as well increase, then obviously there are going to be opportunities where people want to partner with us, or we may see opportunities to partner with others to do transactions both inside Jamaica and outside. So it's just, it's just a normal, regular course of business for us to consider transactions in all markets because we are a regional investor.
Thank you very much, Jason. All right, and the final question: will Miami Bay and Lake Spin be the main projects for the second investment life cycle? Also, are there other projects that SRF is considering to acquire in short order?
Yeah, in terms of flagship projects, yes, there will be the two main ones, but they will not likely be the only ones. As I think when Jason went through his presentations, you see that there are other assets on the balance sheet, including Delphin Holdings. But yes, in short, those will be the two main flagship projects. The second part of the question asks about other things in the works. As you can imagine, yeah, we do have a very high velocity of opportunities that come our way, and clearly, a big part of our mandate on your behalf or on behalf of investors and shareholders is to have a system in place to navigate the opportunity in each one of those as they come to us. But what I think your question really speaks to how healthy is our pipeline going forward for SRF, and what I can say is that we do have a very healthy pipeline of projects. But clearly, we will do significant assessment before those pipeline opportunities actually become mandates or become projects that we will bring into this particular forum here. But so yes, Lake Spin and Miami Bay will be the two flagship projects, but there will be others. And yes, we do have a very healthy and robust pipeline of projects in the works for SYGNUS Real Estate Finance.
Thank you, David. All right, so we've addressed all the questions, and we're now at the end of our earnings call session. We would like to extend a big thank you to everyone who attended the session today. As a reminder, we are encouraging you to read the published quarterly results alongside the audited financial statements for the year ended August 2025 and the management discussion and analysis that we provided alongside the quarterly results. All the documents I've mentioned can be located on the Jamaica Stock Exchange website and also on the SYGNUS Group website in the Investor Relations section. So that's www.sygnusgroup.com. Shortly after the session, a recording of the earnings call will be made available on our website, as well as a copy of the presentation. Thank you and have a great day.